Hello, welcome to everyone. My name is Jeremy Sauter. I'm the membership director for the French American Chamber of Commerce New York chapter. It's a pleasure to have so many of you today. We have many members and guests who are attending today. They represent a big variety of our network. We have members in banking, in venture capital, food and beverage, fashion, human resources, software, and more, reflecting our diversity. And today we are starting the last webinar of our stimulus series of webinars addressing the federal program providing COVID relief. We had previous webinars focusing on the legal aspects of the stimulus series, also focusing on the Paycheck Protection Program, the Disaster Relief Loan Program. But today we're going to focus on the tax sections of this stimulus, which is enormous. There's enormous benefits for companies in terms of monetization, in terms of cash flow management to delay payments. So we have today selected some of the experts in our network, KPMG, to walk you through these tax provisions and discuss specifically how you're going to be able to generate liquidity for your business. So I want to introduce the speakers today. We have Valerie Boissou, who is a partner in charge of the US Corridor at KPMG. We have Gans, who is a business tax partner based out of Pittsburgh with only over 21 years of tax experience. And we have Jill Hemphill, who is a tax partner for the Global Reward Services and at KPMG, and helps her clients manage their global human capital. So before we start with the speakers, I want to just do some housekeeping rules here. The webinar today will last for 1 hour in total. There will be about 40 minutes of presentation followed by 20 minutes of questions and answers. So on your control panel at the right of your screen, you have a questions window, a questions section in which you can type in questions throughout the webinar when the presenters are speaking, and we will ask your questions to the presenters at the end of their presentation. Also, I want to let you know that you will receive a copy of the slides of this presentation after the webinar, and you will also receive a link to download the recording. So do not worry about missing anything of that the speakers are saying. It will be recorded and you'll receive a link. So without further ado, I will let Valerie Boissou start with a few words of introduction.
Thank you, Jeremy, and thanks for the Chamber to host us today. So we're very excited to be here. So you mentioned that I lead what we call the Crones US Corridor for KPMG. So I just want to take a few minutes to introduce that concept. The corridor is our French desk, if you will, for the US. So we serve our French companies that are established in the US. The idea is that the corridor provides access to French-speaking and French individuals in all the areas of practice of KPMG to make sure that we provide the best of what our firm can offer with some twists about cultural differences and understanding what it takes to report to a French company. So I'm very fortunate that in that large task, I have George by my side. George leads everything tax related with the corridor. So we're here today to talk about the CARES Act, and you mentioned, Jeremy, that this is part of a series of 4 webcasts that you've already had. We're going to be focusing about income taxes and also payroll taxes. I just want to level set with CARES Act. It stands for Coronavirus Aid, Relief, and Economic Security Act. You probably are all familiar with this legislation by now. It was passed by Congress about 2 weeks ago now. And this is actually the third round of measures that the government has taken in the U.S. to try to address the situation we're in. To give you a perspective of the depth of the program, it's a $2 trillion spending. And just to give a comparison, we had tax reform 2 years ago, and that was only 1.5 trillion, and we had not seen this for 20 years. So you can imagine that for everything in the act, and especially for tax and payroll tax, this is another game changer. Just after we've seen so much change just 2 years ago. So today we will talk about not just the CARES Act. Actually, we wanted this to be comprehensive about everything you can leverage in the tax sphere, I will say. So George is going to start by taking us through some nice reliefs that we have around filing deadlines and payments relief with income taxes, and then Jill will come and talk more about, as employers, what you can expect from the Act and measures like deferring payroll tax payments, for instance. And then George will be back and we'll talk about operating tax losses and how you can basically monetize those losses much better than you would have hoped. So George, let me start with you. We're actually April 13th, so typically in 2 days we would get ready to make our extension payments and our Q1 payments and file our tax returns, and none of it is happening. My understanding is we've got up to July now to do this. Do you confirm this is the good news? One good news in the midst of this COVID-19 pandemic?
Yes. Hi, Valerie. Thank you very much, and hi everyone. Nice to be on this webcast with you. As Valerie mentioned, I run our tax corridor for France. I'm excited to be here. So, yes, let's start in talking about income tax filing and payment guidance. So, as Valerie mentioned, a lot of information has been coming out about COVID and CARES Act, and specifically about relief for taxpayers with respect to filing and payments. So what you see now is the evolution of that guidance. It started with the president declaring a national state of emergency on March 13th. Since then, the IRS came out with several notices delaying certain payments and certain filings, and every notice that came out was more and more clarifying, and lucky for everyone, more and more favorable. And so the latest one, which is really hot off the press, is Notice 2020-23, which came out late last week, which really provided meaningful relief and clarified that any deadline, pretty much, and keep in mind we're talking about federal, we'll talk about states in a moment, any federal tax filing deadline or payment that was due between April 1st and July 15, 2020 is now essentially postponed to July 15th. And so if you followed the evolution of the guidance, originally it was said that extensions and payments, anything due April 15th wasn't due until July 15th. But that left a lot of open questions. Well, what about second quarter payments that are due June 15th? What about fiscal year end taxpayers where their return might be due somewhere between April 15th and July 15th? What about them? So the good news is this last notice really clarified that the IRS and Treasury intend to provide very broad relief to all taxpayers, individuals and businesses, to give them time to get their paperwork in order, filings in order, and to save them cash flow and not have to pay anything between April 1st and July 15th. There is no action required in terms of filing any sort of extension. The postponement is automatic. There's no limit on amounts due. Originally, there was some limits around how much the maximum postponement of payment is. Now that went away. There's no interest and penalties during that postponement period. But anything beyond July 15th does require taxpayer action. And the other point to consider is the extensions, once filed on July 15th, as of today, will only be through October 15th, the normal filing deadline for calendar year corporations and individuals. So once July 15th hits, you'll still need to make those filings. Some additional guidance, again, much broader relief under this new notice. It's anything that files within these two dates, fiscal year end returns, 965H. So what is that? That is the repatriation tax that was part of tax reform. Those were allowed to be paid in installments. So it wasn't clear under the old guidance whether those installments would be due or not. Those were postponed as well. I'm sure many of the clients on this call are impacted by the base erosion tax. That's a separate kind of tax. So the question was whether that would be due or not. That is postponed. Any estimated payments. Information returns that, even though it would be included in your tax return, like 5471s and 2s, carry their own penalties, but it was clarified that those would also be postponed, again, to July 15th. And then finally, refund claims, and particularly Form 4466, that allow you to get refunds on overpayments from the prior year. Those would also be postponed to July 15th. The final point I'll make on this before I turn it over to Jill to cover some of the employee related provisions is, if you're under audit and you have any sort of audit deadlines of providing documents or responding to notices, those are also postponed until July 15th if the due date was between April and July. So very good news overall under your notice 2023, and gives everyone a chance to get everything in order, given everyone's working remotely, and also save some cash flow. So I'll turn it back to you, Valerie, to tee up our next topic.
Yes, and maybe a question before I just do that. You said this is all for federal tax, so do you have some insights as to what the states are doing? Can we expect delay and postponement as well?
Yeah, it's a great question, and as many of you know, we have one federal system, we have 50 states to deal with. So the good news is the majority of the states are following federal guidelines in terms of deadlines. I'm not going to say all of them, and we do have a matrix that is available to clients on our website that shows you what states are complying. We can talk about New York, for example. New York has postponed the deadlines to July 15th, very similar to federal. So it's really a state-by-state analysis, but the good news is most states are following Fed, and we'll probably be waiting for July 15th as well.
All right. So thanks, but not a 100% clearance, but almost. That's good news. I think New Jersey is one state that hasn't actually followed the federal guidelines. So yeah, something to keep mindful of. So Jill, back to you now. I think you've got some nice provisions in the CARES Act that will speak to every company that is employers. We can see some true intent from the government to try to preserve employment. So that seems to be through two main mechanisms. One is that payroll tax payment can be pushed to 2021 and 2022, and there's also some retention credits for employers. So can you explain to us what this is?
Yeah, thanks, Valerie, George, and Jeremy for having me today. There is a lot in the CARES Act and a little even beyond the CARES Act of, I think, hot topics related to employees and payroll considerations. We have a number of slides in here on all the topics contained in the legislation. Given our short time together today, I'm going to focus on the three items that I think have the highest potential value as well as the broadest applicability. So those three areas, two of them are part of the CARES Act that Valerie mentioned, the payroll tax deferral and the employee retention credit. But I'm actually going to start off with a tax idea here, a concept that is not part of the CARES legislation. And George, you can move ahead to slide 11. It's code section 139, and this code section has been in our U.S. tax code for many, many years, but it basically remains dormant and inapplicable unless there's a federal disaster emergency declared, which did happen in the case of COVID on March 13th. And what this provision, many of us are familiar with it in the context of natural disasters, so floods and hurricanes and whatnot. This is obviously our first experience using 139 in the context of a pandemic. It's a highly tax efficient opportunity. It allows employers, it's not a requirement, but it does allow employers to pay disaster related payments to employees on a tax-free basis. So the payments are tax-free to the recipient. They are fully tax deductible by the company. The provisions intended to be relatively simple from an administrative perspective, allowed to help people during very, very challenging times. So in rethinking this code section in the context of a pandemic, what we see some organizations doing is using this as part of their, I'll call it, employee care strategy. And with the sort of breadth of different situations that employees are facing, there's a group of expenses that we do expect many individuals, if not all of your employees, are facing some or all of these items, such as unique child care arrangements, perhaps unique educational expenses because schools are closed. So it could be tutors, it could be online education services, it could be books or, craft materials, things to support home education. Certainly anything that is medically related to a COVID diagnosis, any sort of prescriptions, anything that's not covered by insurance could be covered by one of these 139 payments. Again, it's fairly broad. The one thing that you cannot do under 139 is make income replacement payments. So we've gotten some questions over the last few weeks. Some organizations where they still have employees that may be facing the public wanted to make hardship payments or, premiums for continuing to go into the office. Those sorts of payments are not within the bounds of 139. But we do see organizations making various levels of cash payments to employees to cover the kinds of expenses that I mentioned. In addition to those, maybe childcare, education, medical items, a lot of employees are faced with unique work from home expenses. It might be equipment, it might be increased utility or data charges, it might be enhanced Wi-Fi. All of those things are clearly COVID related. If you choose to make those payments to your employees, those could be done on a tax-free basis. Some of what I mentioned, particularly around home office, could be an ordinary and necessary business expense as well, which would effectively get you to the same result where it's not a taxable payment to the recipient, but still deductible to the company. Which is perfectly fine. Some of you may, have gone down that expense reimbursement path. And really the only difference is that if you do it under your accountable expense reimbursement plan, you do need to continue to follow those guidelines as far as documentation, receipts, and whatnot. Whereas under 139, there is no formal documentation requirement, so you're not required to collect receipts from individuals. And different organizations sort of handle the documentation differently. Some, from a governance perspective, still prefer to have the receipts, but again, it's not required. So I bring that up again as just maybe another tool for you to think about as you're all navigating, some of the unique situations related to COVID. One more example there, we see this in the mobility space, and given that we have a audience with French connections here, and perhaps lots of employees going back and forth between the U.S. and Europe. We've certainly run into a lot of cases where people have ended up sort of trapped in places where they weren't anticipating and in need of temporary housing. Could be because of a quarantine situation, could be because an assignment was disrupted and, they ended up staying in one location longer than expected. Those temporary housing expenses, again, if it's directly related to the virus and sort of the quarantine circumstances or travel restrictions, we think those would be very legitimate 139 expenses. Again, those are going to be more unique situations where you might want an additional layer of approvals or documentation, but we think 139 should certainly be considered in those cases. On this slide, we've also got a notation about charitable considerations, and this is quite a broad topic. I think, could almost warrant a webcast of its own. We are getting a lot of inquiries about companies wanting to support different sorts of charitable efforts, whether they be broadly applicable to the community, perhaps support healthcare workers, or to support their own employees in particularly difficult circumstances. There are a number of different ways to do that. I don't think the time will permit for us to go into those all today, but again, it's another avenue here as you're considering, all the different sort of aspects to managing your employee population and some of the unique needs that they may be facing. Moving on to the CARES Act provisions, we have a kind of a broad overview here of all of the provisions. I'm actually going to jump ahead straight to slide 13 and the payroll tax deferral. This opportunity has the broadest application. It basically has no particular eligibility requirements other than you need to be a taxpayer who's paying employment taxes. So the provision allows you to defer payment of the 6.2% OASDI tax that the employer is paying. So the employer portion of that 6.2% tax. That can be deferred 50% to the end of 2021 and 50% to the end of 2022. So this is purely deferral. There is no tax reduction. You would calculate and accrue these taxes as normal, but you can defer payment. So it's basically a cash flow, cash management strategy. The one sort of eligibility criteria to keep note of is that if you ultimately take out an SBA loan and there is loan forgiveness, then you become ineligible for the payroll tax deferral. So we're starting to get some procedural guidance on what exactly that means and how it could, impact operations. This was an area where some of you on the phone may have already started the deferral process. The deferral applies for deposits beginning after the enactment date of March 27th. So again, depending on your payroll cycles, you may have already deferred tax. If you later determine that you will be receiving SBA loan forgiveness, we believe that you can kind of stop your deferral at that stage and continue down the loan forgiveness path. So it's not an absolute, you must choose today, particularly since these loan programs do take some time to get up and running and there's an approval process. So we do see a number of organizations go ahead and take advantage of the deferral while they're still in the loan process. George, we can move ahead to the next area, which is the employer retention credit. This is probably the most complicated of the three topics that I'll discuss today. It does have relatively broad application, but there are a couple of definitional hurdles that need to be considered before claiming the credit. And the first is whether your organization is an eligible employer as defined in the Act. And there are two prongs to that criteria. The one is a pretty objective test based on gross receipts. If you can show that you had a 50% or greater reduction in gross receipts as measured over the same quarter of the prior year, you would be an eligible employer. Now, fortunately, there aren't that many organizations that meet that other than, maybe some of the entertainment venues, restaurants, but most of our businesses are still, maintaining some level of gross receipts above that 50% reduction. So it's really the second prong that we focus on. And there you become an eligible employer if your operations have been fully or partially suspended by a government order. And again, we don't have a lot of deeper guidance on this, but given the level of impact we're seeing across the United States, almost every state and major metropolitan area are under some sort of governmental orders. Those obviously vary from, reduced hours, restrictions on number of gatherings, restrictions on travel. All of those things we believe would constitute at least a partial shutdown for most organizations. So again, given where we are in the crisis, most companies would probably satisfy this criteria. The places where I think you do have to be cautious is if you are a business that is operating solely in one of the few states now that do not yet have orders in place. And there are still a few, mostly in the Midwest and Western part of the United States. So assuming you meet that first criteria of being an eligible employer, then the legislation sends you down one of two paths. The first, if you have fewer than 100 employees, then the calculation of the credit is more favorable and a bit simpler. If you have greater than 100 employees, which is where I'll focus today, I think that's probably where most of our audience falls, then you have to identify only those employees who are not providing services. And to the extent you're still paying them for either a complete furlough or even a partial time in which they're not providing services, that would be our qualified wage element. And this is where it is a bit challenging to generalize because every organization is in a different set of circumstances. And particularly when we have as broad of an industry group as we do today on the webcast. But I'll try to give you a few examples that hopefully can help shape your thinking about how this might play out in your own companies. The easy case would be, say you have retail operations and your retail stores are either completely shut down or running, very much a reduced group of people in the stores or reduced hours. To the extent that you continue to pay those retail workers for some or all of the portion of the time that they're not working. So let's assume they normally work a 40-hour week. Now they're only working 20 hours and you decide to pay them for, say, 30 or the full 40 hours. The piece that you're paying them for when they're not working, clearly qualified wages. Okay, those are the easy cases. Then we go to the other end of the spectrum and some of the challenging cases where many of us on the phone, tax, finance, HR professionals, we are generally working at home. For many of us, our core job responsibilities have not really changed. We may or may not be able to be as productive and sort of accomplish as much from home as we would if we were in the office. And those, even within that can fall into a couple of categories. We are certainly hearing a lot of families having challenges with young kids at home. And while the job may be conducive to working from home, if, parents are spending, say the morning on educational matters, maybe they're only working, 50, 60, 70% of the normal time that they would be committing to their job. If that can be documented, you probably also have qualified wages in that situation. Some of these will be less clear. It may be that people don't self-declare as, having sort of personal time with families or maybe taking care of folks who may actually be stricken with the virus. But something about the business has just changed in such a way that they're no longer doing as much work as normal. And again, I'll use an example from the insurance industry. So we're hearing from a lot of our insurance clients that their property and casualty claims are down significantly. Less people driving, less auto claims. And so in some cases, they're reporting their claims adjusters are down 70, 80% over the same time in the prior year. if those people are not being either asked to do things like training or being redeployed to other parts of the business, then we've probably also got a group where we could really measure the time that they are no longer working. So again, that's going to look a little different in each organization, and your overall HR strategy, you want that to align to the kind of support that you're building to claim a retention credit. So this is an area where I think it's critically important that tax and HR work closely together to make sure that we're identifying the right pockets of individuals who might be eligible for the credit, and then documenting it appropriately, all within the overall HR and people management strategy. So again, lots of just kind of interesting situations coming up. I think initially some organizations kind of read the statute and sort of the provisions of the retention credit, maybe thought it wasn't going to apply to them, but the longer this goes on, the more and more pockets of people that we find who really are not able to do their jobs, again, for different reasons in different cases. I'll also just highlight something in the retention credit provisions of the Act itself. It's very, very unique. For those of us in the tax world, I'm not sure any of us have ever seen this done before. We were chatting amongst ourselves and couldn't come up with any examples. So it right in the face of the statute, it basically says as long as you have a reasonable basis for claiming the credit, no penalties will be imposed if in fact there's, it's later determined that the credit was not supportable. So you may still be faced with interest charges, but they've essentially taken penalties off the table, again, as long as you have a reasonable basis for claiming the credit. And again, it's just a very unusual provision from a tax perspective. And, we've been trying to understand, why was it done this way? And I think there's a couple of theories out there. One being that Congress recognized that, employers would need support quickly. We would try to need to, the idea here was that this was a stimulus bill and we wanted to get money back into the economy as efficiently as possible. So employers would be faced with interpreting this without the benefit of a lot of time for formal notices or proposed regulations. So I think that's part of it. And then the other part, as we continue conversations with Treasury and with some of the drafters in the Senate, the feedback that we're getting is more along the lines of this being a true stimulus bill and, less about a formal piece of tax legislation, which again would come together in a very different way. So I think, those two sort of pieces of information, when you put it together and try to figure out what is the right position for your organization, there is certainly some room for interpretation on this. And again, I think you want to be able to put your organization in the strongest position possible. And I think you can do that by having the tax and the HR teams work very closely together. So those are the three real highlights of the CARES Act. I'll mention just one other item because, again, it's kind of unique and it may be helpful in some particular circumstances. The Act also allows employers to pay off qualified student loan debt for employees, again, on a tax-free basis. So it's a bit of an unusual provision, may not have broad applicability, but it might be useful to you in certain scenarios. The loan forgiveness is tied to the qualified education benefits that you might already be offering. So to the extent an employee is already receiving some benefits under that program, you can only take a combined total of $5,250 in benefit there. So you'd have to pull together the education benefit plus the student loan repayment to measure the limitation. So I think those are the main pieces. We've got a slide up here on the paid leave provisions. This was actually the first piece of legislation that Congress put out. This the only thing I'll note about this is it is mandatory. It's a little different than the payroll tax deferral or the employee retention credit. If you are an employer who's subject to these enhanced sick leave or enhanced FMLA provisions, it is required that you offer it to your people, and then it allows you a credit for doing so. But again, those are a little different than the others, where it's simply optional participation.
So thanks, Jill. I think that was really insightful. Sorry, I you out. Just before you finish, you mentioned a couple times, going back to Congress and room for interpretation. What do you expect? Do you think there will be more, refined bills, or is this program going to stay as it was?
Yeah, Valerie, almost certainly. We're expecting a couple of things. We are expecting more clarifying guidance. Not exactly sure what form that will take. It could be additions to the FAQs that the IRS has already published. We are expecting a revised 941 form, which will help us with some of the operational guidance for both the payroll tax deferral as well as the employee retention credit. And, I think everybody's probably watching the news, and already Congress is talking about another package, so another piece of new legislation. So there's definitely more to come. The exact timing and content, of course, is still a bit of an open question.
All right. Yeah. Interesting. I want to come back to something you also mentioned, which was the payroll tax deferral and the overlap, I will say, with the SBA Loan Program. So it sounds like there could be a little bit of opportunity to dual track and make some scenarios for companies to kind of assess what's the most efficient route to go.
Yeah, I think that's right. Even with the complexities of the employee retention credit and the payroll tax deferral, I think most organizations could be in a position to take advantage of those quicker, probably than what the loan process is going to take. With the loans, we're all a little bit at the mercy of, the banking organizations, which are under, it's kind of a tremendous strain to put up lending platforms and approval processes. So we know that's going to take a bit of time. In the meantime, we do think that companies can and, perhaps should look into both of these payroll opportunities. And then if and when the loan materializes, we can either undo the deferral or, again, we may get some clarifying guidance on exactly what sort of cutoffs there are for these benefits vis-a-vis a loan, either a loan application and or the forgiveness.
Okay. Well, thanks very much. So, George, we're back to you with income taxes, and I think you've got some nice things around NOLs. So NOLs, for those who don't know, are net operating losses. So basically income tax losses that companies typically would carry back to offset past tax income, or would push to the future in order to offset a future tax liability. So that seems fairly simple. The concept isn't new, but I understand that since tax reform, we had different types of NOLs, and so they may not react exactly the same. So what's in store, George?
Sure, thanks, Valerie. So between now and the end of the webcast, we'll kind of pivot back to income taxes. We'll talk about NOLs and then some other opportunities. So as Valerie mentioned, one of the big benefits of the CARES Act is the introduction of a new NOL bucket. So for those of you who followed, right, pre-tax reform, so for years 2017 and prior, NOLs were allowed to be carried back 2 years and forward 20 years. And with the elimination of the alternative minimum tax, they were eligible to offset 100% of taxable income. And then post-tax reform, the rules were indefinite carry forward with no carry back, but only offsetting 80% of taxable income going forward. Now, CARES introduced a third bucket, sort of in-between bucket, that is very favorable and beneficial, and that is one that for any year beginning after 12/31/17 or prior to January 1st, 21, you have a 5-year carryback window. So basically, if we think of calendar years, 2018, 19, and 20 can be carried back 5 years with 100% offset of taxable income, which is a huge benefit if you think about it, because for those of you who remember tax reform, when it passed, we went from 35% rate to 21%. And so we were all talking to our clients and trying to find ways to maximize our tax dollars and to take as many deductions as we can under the 35% regime before we get to 21%, and to look for that permanent 14% benefit. Well, now Treasury gave us one last chance to get those high tax dollars back because we're taking 21% losses from 18, 19, and 20 and carrying them back to potentially 35% years. So that's a huge benefit that a lot of companies are welcoming, obviously given the need for cash. And let's talk a little bit about some issues around that. So aside from the rate benefit, of course, there's opportunities to enhance losses if we're thinking about, if we're in a loss, but we think we could be in a bigger loss. Let's look at accounting method changes, some disaster losses. So Code Section 165I is a special election that because we're officially in a federally declared disaster area, which is the entire country, we could potentially take deductions that happened in 2020 in our 2019 return. So ways to increase those losses and carrying them back are conversations we're having with clients. The other one is potentially changing year end. So if you're in 2020 and you'd like to benefit from this provision as much as possible, you might consider changing your year end to a November 30th year end, which would then give you another year of losses from 12/1/20 through 11/30/21 to carry back. And if you think about and believe what you're hearing, that this crisis will not be one that will reverse quickly. It's not going to be a V-shaped recovery. It's going to be more of a U or very big U. Then we might expect losses to continue throughout 2020 and through 2021. So a year-end change would give you another year to carry losses back. So that's just another thought. And then other things to think about are, especially for the tax reform years. So if you have losses in 2020 that you'll be carrying back to 18 and 19, you really want to think about all those tax reform items that will need to be recomputed, as, for example, your 163J interest expense limitation, your GILTI expense of FDII, foreign derived intangible income benefit. And if you're carrying prior to that, then you have to think about corporate alternative minimum tax, which was still enacted for years prior to 2018. So the message here is, when you think about doing these carrybacks, you need to be careful, especially in post-tax reform years, to make sure you're not whipsawed and you don't end up with less refunds than you think. The BEAT is another great example where you might carry back and wipe out income in 2018, but all of a sudden then be subject to the base erosion tax. So make sure you model these things out and think them through before you go ahead and make those changes. The other point here on this slide is you can elect to relinquish the carryback period for any year. So just because it's available doesn't mean you have to carry them back. All you need to do is make an election on the most recent year post this CARES Act, which is essentially 2020 for calendar year taxpayers. As long as you put a waiver election in your tax return, then you should be fine. But don't forget that waiver election, because if you don't, you might run into trouble. And then capital loss carryovers have not changed. So again, if you had capital gains and you want to carry back capital losses, you might want to think about how to combine those two together as opposed to filing separate returns. Some considerations from an inbound perspective. Obviously, most of the crowd on the phone today are inbound companies owned by foreign parents. Once you get that cash back, what are you going to do with it? Most likely, if your parents in France, they'll want the cash. So think about repatriation strategies, whether it's through dividends or loans, and what comes with that: earnings and profit calculations, withholding tax issues. Just think about those things while you're getting your cash back. How are you going to get it back up to your home country? The other point to mention is the interaction with the transaction tax. Remember, we talked about Code Section 965 and the fact that there's a transition tax because of tax reform. Those taxes cannot be eliminated with this NOL, so there's a sort of a default election that you are deemed to have made where you're not going to use these NOLs to offset your transition tax. So those will not be, you won't be able to recover those. You will be able, however, to skip any year that has an inclusion. So 2017 or 18, if those included transition tax and you believe that not carrying back to that year is beneficial, you can officially skip those years and just carry back to those years where you'd like. So that's, again, another benefit. But what you can't do is use the NOLs to offset your transition tax. I'm not going to cover this slide in great detail on the first piece. There are special rules for life insurance companies and REITs. If any of you are in that industry, just be aware that those rules are different, and look into those, consult with your advisors before you do anything. The second piece is interesting. There's a technical correction. For those of you who are fiscal year-end taxpayers, you might remember that when tax reform passed, they canceled the carryback availability, but they made a mistake when they wrote the rule, and they applied it to taxable years ending after 12/31/17 as opposed to beginning after 12/31/17. And so fiscal year end taxpayers who fall within that now can go back and have that 2-year carryback claim. And so that's another nuance, but it's a very important one for fiscal year end taxpayers that fall within that category. So if you are in that window, know that you now have this additional carryback opportunity. As I mentioned, there's a temporary suspension of the 80% limit on the taxable income. It's now all 100% until it goes back to 80% after 2020. So again, a nice benefit there. And then finally on the NOLs, there's also an acceleration. So that was pardon me, that was the NOLs. Now we'll move to acceleration of corporate alternative minimum tax credits. Under tax reform, as you know, alternative minimum tax was abolished, so it's gone. Yet a lot of companies still had credits carried forward. So under tax reform, you were able to utilize those credits and claim refunds all the way through 2020. Now that refund is accelerated to 100% in 2019, and you can actually go back to 18 and take 100% in that year if you so choose. So another way for the government to get more cash in the hands of taxpayers faster than what was intended under tax reform. So now I'll move on to a few other tax provisions that are available under CARES Act and other things to think about before we wrap up with some final thoughts, and we'll try to give a few minutes for questions. I'll say right now, we see a lot of questions coming through. I try to reply to a few as we go along, but if we're not getting to your questions, we'll make sure to respond to them after the webcast. So please keep sending them in. But last but not least, a few other tax provisions to think about as we are considering what to do under the CARES Act. The first is interest expense. So under tax reform, if you recall, there was a new code section 163J with interest expense limited to 30% of your taxable income before interest, tax, depreciation, and amortization. CARES made two significant adjustments to this. One is they increased the percentage to 50%, which is already a great advantage. The second was to calculate that 50% limit. You can use either your actual year for 2020, or because many companies are expecting 2020 to be less taxable income because of everything that's going on with the COVID, you can rely on your 2019 taxable income to compute your limit. So you could be in a situation where you don't have sufficient taxable income in 2020 and otherwise have been limited, but now you'll be able to use more because of this exception. So again, great exception, just another way to incentivize companies to get more deductions, get more tax dollars in their pockets. There's also excess business loss for non-corporate taxpayers that are available. So make sure if you're not a corporation, I know we're very corporate focused, but flow-throughs also have the ability to utilize excess business losses. The next is also a very important technical correction for qualified improvement property. So one of the glitches under tax reform was that qualified improvement property, which is leasehold improvements, before tax reform had a 15-year life, which would make them eligible for bonus depreciation. Under tax reform, those were moved to a 39-year life, which took them out of bonus. This was a provision that hurt a lot of retailers and restaurants and hotels. They corrected this glitch through the CARES Act, which means that now all QIP are eligible for bonus depreciation in their 15-year property. This is not an election, and so if you did have QIP under 39 years, you do have to go back and fix it. The good news is it's probably something you can do through a method change on your 2019 return if you haven't filed it already. And again, provides more deductions, and if you are planning on loss carry forwards, more losses to carry back. So overall, a very welcome and favorable development. And as you can see, between this and the NOL glitch, Congress used this package to fix a couple of pretty important glitches that everyone was looking for them to fix. So good news again overall. So we've got about 6 minutes to go. I'll stop there and I'll start with my own takeaways and wrap ups, and then give Jill and Valerie a chance to kind of cover their piece, and we'll let you go. But from my perspective, if you think about what we covered, the first thing is be aware of all the deadlines on elections and make sure you don't miss any. Particularly when it comes to NOL waivers and other, if you want to waive a year to carry back, if you want to skip a year, make sure you get all the elections in on time. And just because we have this very broad notice from the IRS that allows us to delay everything to July 15th, don't forget you'll need to get things. If you file things before July 15th, make sure you get all the elections in and do it correctly. The second is on the NOL carryback. Watch out for potentially bad answers like the beat, like guilty, missed elections, 965 issues. So again, because of tax reform, NOL carrybacks to 18 and 19 are not simple exercises, and you want to make sure you're not hurting yourself where you didn't anticipate it. And then finally, in terms of the states, I know we didn't talk much about the states, but as you know, states don't have to follow federal, and all these provisions that I talked about are all federal provisions. States have the right to either adopt or not adopt some of these rules, and the states some of them have rolling conformity, some of them you have to vote. So make sure you're following the state rules carefully and don't just focus on federal. So I'll stop there and I'll turn it back to Valerie and Jill to make some last comments.
Thanks, George. I think this was really insightful. It's 900 pages in that CARES Act, so no need to mention that it's complex and there's so much of interrelation. So I just want to point out our resource page at KPMG. So go on our website, kpmg.com. We've got a host of publications trying to dissect the CARES Act in all aspects, and of course we're here to help. So if you to contact us, feel free to do so. And thanks, Jeremy, for giving us again the opportunity to participate today. I don't know if we have time for questions. We still have 4 minutes.
Yes, thank you. Thank you, George. Thank you, Valerie. Thank you, Jill. Yeah, we still have time to answer a few questions. And Valerie, George, Jill, I want to ask you, are you able to stay past 3 p.m. to answer the questions, or should we answer the questions in writing after the webinar?
This is George. I'm happy to stay on if anyone has any questions for me. I can't speak for Jill, though. I don't know. Jill, if you're available.
I will have to drop in a few minutes, but I would be happy to take a couple of questions now and then also follow up on any that we need to via email following the session today.
Okay. So let's start with a few questions, and we will do not worry if your question is not answered right now. We will one way or the other answer your question either via this recording or through the email follow-up that we will send to all participants. So the first question we have here is if we have an SBA loan and it is not forgiven, then can we defer the payroll taxes?
Yeah, the answer to that is yes. I did type that in I think that question may have come up from 1 or 2 audience members, but the answer is yes. The conflict would only come at the point you are having loan forgiveness.
Okay. Another question is for the employer retention credit, is the 100 employees full-time equivalent, 100, is that for 100 employees full-time equivalent, or is that for total active employees? And what time frame does this look at in terms of employee count?
Yeah, Jeremy, I think that's one I'd probably like to share some of the specific written guidance that we have on that one with the participants as a follow-up to the session,
okay.
if that's okay.
Okay.
There's a few complexities around both how you, there's a consolidated group concept that first needs to be applied, as well as the head count. So both of those get into a little more complex analysis, so we'll send that as a follow-up.
Okay. Also a question, can a 501c6 nonprofit corporation apply for the employee retention credit if they have already applied for the economic injury disaster loan?
That one is, it's also an area where we're expecting some additional guidance potentially. The guidance that we've been receiving has been expanding the type of entities and organizations that are eligible for these provisions. We do have specific guidance on the 501c3s. I don't believe we have anything specific yet on the C6 organizations. So again, I can't promise that there will be additional guidance on that, but we are seeing some of those organizations being addressed in the subsequent guidance.
Okay. Another question, is there any guidance on what qualifies for quote unquote partial closure? For instance, if the office is closed and the receptionist is not working, but the rest of the employees are, would the receptionist salary qualify?
Yeah, as long as you're an eligible employer, then once you pass that hurdle, then you can look to individual, either very personal circumstances to a unique employee or to groups of employees potentially. So in that example, if you only identified the one person who was not working, that would result in eligible wages, but the fact that others were still working would not disqualify you. Okay.
And what about if an employee is only working 10% of the time because most of the clients suspended their orders, but we still have some clients asking us to work?
Yeah, I think that's probably a fact-specific situation. I think in general, it's definitely worth looking into and understanding whether we can confirm that a person is really only working, say, a small percentage of their normal workday. And again, I think it would go back to the other circumstances around that person. Are they being asked to redeploy to help out in other areas? Are they asked to be, asked to do training? If they're being asked to do other things to fill that downtime, then probably not creditable wages. If we can confirm that they are not working and they're not being asked to do other things, then I think probably a very good case for qualified wages.
Okay, and for the employer retention credit, the employee retention credit, if the credit is greater than the Social Security taxes paid, how do we get the additional refund/credit?
Yeah, and Jeremy, I'll have to probably make this the last question for my section of the presentation. But the way that you access the retention credit funds is through the 941 payroll process. So you start with the employer portion of the FICA tax. And if the credit, your retention credit, is greater than that amount, then you can also subtract the credit amount from the employee portion, from the Medicare taxes, and even from the regular income tax withholding. So basically, you recuperate that credit by reducing your payroll deposit. Now, if you get to a situation where your credit is even larger than your payroll deposit, then the credit is refundable, and there's a unique form that you would fill in to recapture that amount.
Okay, thank you, Jill. And maybe for George or Valerie, what form is used to get the alternative minimum tax credit refund?
Okay, so you basically have to put that on your tax return. So you would get it through the return you file, either on the 1120 itself, or if you want to get it through a quick refund, you would do it on Form 4466. So it really depends how you want to access it. If you want to go back to 2018, you might have to amend the return. So it depends what your situation is, but that credit refund is through the normal tax system.
Okay. Do we have time? Do we have time for one or two more questions?
As long as I can answer them, yes.
Okay. So one question is, can you please talk about the sales tax too? I was told we could postpone them. We pay them monthly, but then was told that we can only if we pay them quarterly or annually.
Yeah, and I did see that question. And so sales tax is governed by the state. It's not a federal tax. So unfortunately, every state gets to do what they want from a sales tax perspective. So this goes back to what I said before. You have to really look state by state what their rules are. Many states did defer or postpone sales tax payments, but unfortunately, it's not a simple answer. And so the person in question that asked that question reached out, and I will send, and this is to all the folks on the line, if you're interested, again, we KPMG on our site, we have a link to a matrix that shows state by state breakdown of the deadlines and filings, and I'll send it over to this particular participant, but if you'd like, I can send you a copy. You can share it with the rest as well.
Okay, thank you. Thank you, George. I think we should all today thank our presenters, Valerie Boissou, Jill Hemphill, and George Gans of KPMG for this very detailed, very insightful presentation. I'm sure will help many of us accessing this liquidity. And again, as promised, we will send to all of you the slides of this webinar together with the recording. And any question that has not been answered will also be answered in a follow-up email. So again, thank you to our presenters, and I want to invite all of you to look at the calendar of events at the French American Chamber of Commerce New York chapter, FACC-NYC.org, And you will see we have many webinars of interest, some offered by the other FACC chapters throughout the country, and also some offered by our members. So I invite you to check them out and register for them. So again, thank you, and we hope to see you soon online. Thank you.